So very quiet, but with a bit of a green bias to it.
Just up 0.1% on the Nifty and the Sensex, but at least there is that intraday recovery.
For the Nifty, absolutely flat right now with some negative bias.
It's been a pretty sort of choppy kind of session all day today. And it's been up and down, and you'd be right both ways, having different market views.
So Nifty is going to go home with the final tick actually at the low point of the day. ITC, the long-awaited news did come about with regard to separating of that hotels business.
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonal Bhutra. Here are the headlines for the day. Sensex declines nearly 300 points and the Nifty falls below 19,700 after a muted session. Midcaps underperform. FMCG index sees a sharp fall. ITC sees profit booking, decides to spin off its hotel business. Company will hold 40% stake in a wholly owned subsidiary called ITC Hotels. Shareholders will hold the remaining 60%. Shares of ICICI Bank hit a record high after reporting a strong first quarter. Kotak Mahindra Bank shares dropped 4% even after reporting a steady first quarter as retail loan growth remains soft. Vedanta slips over 2% on missing street estimates on the margin front. TVS Motors tumbles 3% despite a steady quarter. SRF sheds 3% on a weak quarter one, while good results boost RT Drugs and Ashok Leyland. Nifty Metal Index tumbles close to 1% as global prices remain under pressure as US dollar strengthens. Top metal stocks like JSW Steel, Tata Steel shed close to 1%. A muted session on the Lal Street saw the market end the day largely lower. Nifty and Sensex ended over 0.25% in the red, with the Nifty ending below the 19,700 mark. Broader markets fell in line with the blue chips. Surbhi Upadhyay is here with the details. Surbhi, a weekday on D Street.
Well, it's been a very cautious and slightly subdued start to the week with the bulls on a bit of a back foot. And that's because of the late sell-off that pushed the Nifty down below the 19,700 mark. Today was all about large cap earnings reactions coming in and also some news reactions. And most of these were on the downside. I'll start with the earnings. Kotak Mahindra Bank was down from the word go, 3.5% lower. There was more selling on Reliance. There was selling even on an ICICI Bank. In many of these cases, you can't really argue with the numbers. Most were pretty much in line or even above estimates, but then the market decided to sell on the smallest of reasons. ITC was a big mover towards the last 1 hour. That's because the news finally became official, as you heard first here on CNBC-TV18. The demerger of the hotel business is happening, but the reason the stock fell 4% is that the market seems very confused about the structure, the 60-40 mix that ITC has decided to go with. So that was a stock that was on the lower side. Now, what was batting for the bulls on the other end? Two big stocks. We had TCS seeing some green. L&T ahead of its numbers was positive. So was SBI Life. The midcap index also lost momentum towards that last 1 hour, and a lot of result reactions beyond the index also were negative. Look at SRF down 3-4%, Paytm, IGL, Vedanta, DLF, pretty much red splashed across the screen. There was one theme, however, where there was lots of buying happening, and that's on the PSU side, specifically when it comes to the renewable power sector. So PFC and REC reacted very sharply to reports about PFC looking at a very large chunk of lending on the renewables side, and that helped stocks like SJVN and NHPC to a large extent as well. So some green over there, but otherwise lots of caution. Tomorrow is a very big day for results. Just to name a few, Asian Paints, Bajaj Auto, L&T, Tata Motors, SBI Life, and Delta Corp and Dixon among the mid-cap. So promises to be a busy session and some more clarity perhaps on the way forward for the index as well.
Oh yes, that's right. It is going to be an important day for earnings tomorrow as well. Thank you, Surbhi, for joining us with that take. In market opinion, Ramdev Agrawal, chairman and co-founder of Motilal Oswal Financial Services, says market levels will double in the next 5 years. He also adds that bank earnings this quarter have been fantastic and way beyond estimates.
I think most probably in September quarter you see even more dramatic fall in the raw material cost and hence margin expansion for the non-financial companies, consumer companies or cement companies, steel companies. You see margin expansion. So don't bother too much about the market levels because this all-time high is for last 75 years. It is not for next 5 years. We are going to see significantly higher Nifty, Sensex in next 5 years. Almost I would say double from here. Market may re-rate to a different level altogether, in the sense that from 2021 P multiple, because the only way you can accommodate flow from both sides is either there is a massive boom in the paper flow from the corporates, or the market itself re-rates to 25, 26 times before, and then of course paper flow will come. So, so that's the kind of situation right now. Something may change. Banks have kind of really been fantastic. I mean, way beyond any analyst estimates.
Okay, that is an expert opinion coming in. Moving on to the second headline now. It is a big one. CNBC-TV18 Newsbreak is confirmed. The board of ITC has granted an in-principle not to spin off its hotel business. The company will hold 40% stake in a wholly owned subsidiary called ITC Hotels. Mangalam Malu, who broke the news first, is here with us with the details. Mangalam, what does it mean for the company?
Well, the detailed rationale, that the company will report as to why this structure would be on August 14th itself, I guess, when the board meets, and then there is some clarity on what they propose to do going forward. The street is a little confounded on this 40-60 structure, like you said, but a large part of that, my sense, is primarily to retain the management of the hotel business itself, because ITC per se as a company has no large shareholder classified as the promoter of the company, and the large shareholders that there are, hotels is not one of their core businesses. So maybe to retain the management control of the business, we could have had the board or the advisors talk about this structure itself. But talking about the structure, the company will hold 40% stake in the new entity. The balance 60% will be distributed to shareholders on a pro rata basis. So that would have a market-determined valuation of the ITC hotel business. And together, they will continue to own the synergies of the business itself. So that will be a big positive. But talking about the businesses itself, I mean, the hotel business contributed about 5% to the company's revenue and operational performance. But if you notice, over 20% of their capital was allocated towards the hotel business. So to that extent, it was a business that had lower return on capital than all the other verticals of ITC. Most analysts value ITC's hotel business anywhere between 16 to 20 times 2-year forward EV to EBITDA, and that's a near 20-25% discount to the industry leader, that's Indian Hotels. The good part about this demerger is that it's coming at the right time, value unlocking, because the last 2 years have been phenomenal for the hotel industry. The big question is whether this sustains or not, and if it doesn't, then this is perhaps the best time to go ahead and unlock value in this business itself. ITC's FY23 revenue for the hotels business was close to 2,600 crores. The EBITDA was 832 odd crores. So if you look at what the analysts are valuing it at, anywhere between 16 to 20 times multiple, the stock could be valued, the hotel business of ITC could be valued at 12 to 16 rupees per share. And if the sentiments are good enough, maybe all the way up to 25 times, which is at which Indian Hotels trades, you could value the hotel business for ITC at around 20 rupees per share itself. The structure and the fact that there is sell-on news playing out has meant that the stock is under pressure right now.
Okay, all right. Thank you so much for joining us with those details, Mangalam. The third headline now. A rush of banks have reported their first quarter results. ICICI Bank hit record intraday high after surpassing expectations. However, Kotak Mahindra Bank fell nearly 4%, becoming the top Nifty loser despite a stable performance. Canara Bank posted a strong quarter as well, with gross NPA coming in at a 31-quarter low. Abhishek Kothari is here with a wrap on the numbers. Abhishek.
Well, ICICI Bank came out with its Q1 FY24 numbers over the weekend, and records continue to gallow over there. Gross NP ratio of about 2.76% and net NP ratio of 0.48% are perhaps the lowest that you are seeing in last 8 to 9 years. The unsecured book is the highest in last 23 quarters or more, given the fact that it's now at 19.9% of the loans, and this has been aiding the net interest margin. Restructured book at 0.37% is perhaps the lowest in last 10 quarters, and the watch list is the lowest in last 30 quarters, coming in at a mere 0.4%. In terms of PNL versus RPOL, it's a beat on NII as well as the PAT. Kotak Mahindra Bank, the deposit growth is robust over there at 22% YOY, perhaps one of the best that you are seeing in last 16 quarters, and a sequential growth of 6.5% is perhaps the best in last 13 quarters. Asset quality continues to improve. Gross NPA ratio is the lowest in last 32 quarters or even more at 1.77%. On the flip side, the CASA ratio of 49% is the lowest that you are seeing in last 22 quarters, and the core operating profit declined by almost 7%, 6.74% on a sequential basis, which has not gone down well with the street. So PNL, both in terms of NII and PAT, it's a beat on our poll. Canara Bank, the asset quality continued to improve over there. Gross NPA ratio is down to 5.15%, which is the lowest in last 31 quarters. Net interest margin is at 31-quarter high of 3.05% when compared to 2.95% in the previous quarter. The operating efficiency or the cost-to-income ratio is perhaps one of the best that you are seeing in last 5 quarters, coming in at 43.6% when compared to 45.85% in the previous quarter. In terms of the PNL versus our poll, both the NII and PAT is ahead of our poll. Back to you.
Okay, that's all about the banking space, but we'll slip into a short break now. When we come back, we'll tell you all about the other headlines that we are tracking today. Welcome back. You're still tuned into Markets Today here on CNBC TV18. Let's talk about the fourth headline now. Vedanta tumbled over 2% on reporting lower than estimated margins at over 19% versus an expectation of over 21%. This is for the first quarter of this fiscal. The company has also seen a sequential increase in debt. Nigel D'Souza joins in with more analysis on this one. Nigel.
Well, that's right. Vedanta was under some pressure in today's trading session. We already had Hindustan Zinc's numbers with us. But ex of that as well, it was a bit of a miss. You look at the operational performance, the operational EBITDA as well as margins came in lower than what we were working with. The other problem is the debt has gone up by closer to around $2 billion approximately. It's gone up to around 59,000 crores. Now, Citi, they have downgraded the stock to sell and they've cut their target price around 225. They're clearly highlighting the fact that higher leverage is hurting them. One being the fact that they are upstreaming higher amount of dividend in comparison to what they're receiving from Hindustan Zinc. The second factor they pointed out is they're paying those brand fees to the parent, Vedanta Resources. So that's the other one that's hurting them. And thirdly, the sale of the proposed semiconductor unit that's come in from Vedanta Resources to the listed entity Vedanta Limited is likely to keep debt levels elevated. So put all this together, the stock was under pressure in today's session.
Take your point, Nigel. Thank you so much for that analysis. TVS Motors reported a strong quarter. The bike maker has witnessed the best ever margins in the first quarter of this fiscal. However, the stock remained under pressure and closed with cuts of over 2%. Sonia Shnoy is joining us with the key highlights. Sonia, take it away.
TVS Motors numbers were strong but largely in line with estimates. So there was some profit taking that we saw on the stock after the strong run-up that the stock has seen in the last 6 months. In fact, the margins hit a record high of 10.6% this time. This is the 7th consecutive quarter of the margins above 10% for TVS Motor. Apart from that, the earnings were also strong. The top line growth was good. It was a 20% growth that we saw on the top line. This is on the back of a strong growth in the domestic two-wheeler business, while exports continue to be under a bit of pressure. The core EBITDA went up 27.5%, while the margins, as I said, saw 60 basis points improvement on the back of lower raw material costs, the price hikes undertaken, as well as the operating leverage and better product mix. Back to you.
All right. Thank you for that, Sonia. Let's stay with auto earnings. Ashok Leyland was also buzzing on the back of a strong quarter one. Net profit and revenue beat expectations. Shenu Agrawal, the MD and CEO, is confident of maintaining growth guidance in this fiscal. Listen in.
Industry was 8 to 10% growth in this year over last year for MHCV and about 5 to 6% for LCV. We are still maintaining that guidance right now. We were hoping to kind of close the year, whole year with a double-digit margin, and it's very good to see that we have been able to do that in Q1 itself. And that has come because of many factors. I think firstly, our mix has continued to improve. Secondly, we have been able to fetch better prices, and that is on the back of our new products like Avtar and Bada Dost.
Okay, that is about Ashok Leyland, but the other stock that reacted to earnings is Aarti Drugs, rallied over 17% on the back of a YOY improvement in results. The company's margins have improved on a yearly basis. CFO Adish Patil said they can maintain margins at current levels if raw material prices sustain. He also says he also lays out Aarti Drugs targets for this year.
So last couple of quarters, we had seen a heavy decline in the raw material prices. But because of that volatile scenario, we had to book a lot of inventory losses as well in the quarter of December and some bit in the quarter of March as well. If the prices stabilize where they are, then definitely there will be more gross contribution expansion, which we are hoping. So our target EBITDA margins for a longer term is around 14.5–15%. Which we expect to reach by at least by the end of this current financial year.
Okay, that is Aarti Drugs. The stock ended higher by 17%, but what did not do well is SRF and IGL on the back of weak Q1 numbers. Let me start with SRF. Reported numbers just a while back and it fell in trade by 3%. It was a top-down miss and that was led by their chemicals and the packaging business as well. So revenues lower than estimates came in at 3,300 crore rupees, margins at 21% versus 25.5%. The estimate was of 22% margins and net profit also declined, almost halved on a YY basis. If we look at their segments now, the technical textile segment saw a decline in revenue, so did the chemical segment, but a bigger decline came in their packaging business, and that is something that we saw in the EBIT as well. That will come up for you. Technical textiles, of course, the EBIT declined on a high base, which was expected, but chemicals business also saw a decline, which was higher than what was anticipated, and packaging business 32 crores versus 167 crore rupees, leading to a sharp margin contraction to 6% versus 23% because of lower BOPET and BOPP spreads because of higher supply in the global markets. Technical textiles was down 900 basis points and chemicals business also lower. Most importantly, the commentary also doesn't look so bullish. The company says that global inventory unwinding will have some impact on chemicals business for next 2 to 3 quarters. Their packaging business also is seeing a down cycle, which is expected to continue for the medium term as well. More commentary will be seen in their conference call as well, but on the back of this, the stock ended lower by 3%. That's about SRF. Let's talk about IGL as well, because it was a volume miss for the company. Yes, if you look at the numbers, it will look like the margins are higher, but the revenues declined 7% for the company. EBITDA came in at 642 crore rupees. Profit after tax was higher as well. However, it was a volume miss, as I said. Their volumes came in at 8.2 MMSCMD versus 8.4 MMSCMD of estimates. It's a flattish performance on a quarter-on-quarter basis versus an expectation of an increase. And EBITDA per SCM came in at 8.6 rupees versus 8.7 rupees per SCM. Jeffrey says they have a buy target with rating with a target of 565 rupees per share. They did not like the volume miss. It was a margin-led beat, but volumes fell quarter on quarter. It was 2% below Jeffrey's estimates, and this came at a time when they had cut costs and they had cut prices. So ideally, volumes should have gone higher. That did not happen. The stock tumbled in trade today. But let's talk about other stock-related news. Biocon fell over 5% after US FDA issued 6 observations for its facility in Malaysia. Ekta joins in with details. Ekta, tell us more.
Well, yes, Biocon was under pressure today. That is because the US drug regulator has issued 8 observations to the company's Malaysia plant. Now, the US FDA completed 2 good manufacturing practice inspections at the company's insulin facilities in Malaysia. The inspection lasted from 10th of July to 20th of July. They have issued 6 observations to the drug substance, drug product and quality control labs and 2 observations to the delivery devices unit. Now, the observations as per the company are not related to data integrity, not related to any systemic non-compliance. They are related to enhancing the operational procedures, training programs as per the company, and they will be submitting their reply to address the observations as well. However, there is an impact according to analysts with regards to the insulin aspart biosimilar which is used for treating diabetes and has a market size of around $800 million. Now, Bernstein has said that the current inspection is a biannual CGMP inspection, which is a good manufacturing practice inspection, and it is not product specific. However, Biocon is unable to get approvals unless these observations are addressed, which is basically referring to insulin aspart. Now, the estimates that Bernstein is working with for insulin aspart is around $8 million in FY24, $36 million in FY25, and they expect this to probably get pushed to the next fiscals. Now, however, on the larger basis, Biocon is still the first and only biosimilar, and the target market remains intact, which is at around $800 million. So that's the news with regards to Biocon. And the negative side, there was a little bit of positive news that the EU regulator has issued a positive opinion on one of their biosimilars, aflibercept, which is basically used for eye conditions, and the positive opinion going forward is expected to be considered by the European Commission, which would help them getting approval for this biosimilar in Europe probably in the next couple of months.
Ekta, thank you so much for joining us with those details. Moving on to the 5th headline now. Nifty Metal Index closed to 1% lower as global prices remain under pressure on US dollar strengthening. Top metal stocks like JSW Steel, Tata Steel shed close to 1%. Separately, crude prices rose to a 3-month high. Manisha Gupta joins in with a wrap of all the commodity action. Manisha.
Well, it's a 3-month highs for the crude oil prices, which have gained more than 2.5% in the previous week, and that was a 4th straight week of gains coming in for the crude oil prices. Well, the markets do believe that it is going to be a tighter Q3 and Q4, especially with the kind of cuts that we are seeing in from Russia and OPEC and allies together. Well, the fighting in Russia and Ukraine also seems to have escalated, and that seems to be supporting crude oil prices. The Citi latest report suggests that the third quarter average crude prices could be $83 a barrel, so that's exactly where the markets seem to be heading right now. What the street will also watch out for is the rate hike and commentary from US Fed, ECB and Bank of Japan. All of those 3 important central bank meetings are happening in this week itself. But on the other side, metals is a sector which has continued to decline yet again. The strength in US dollar is weighing here. Markets will keep a keen eye on the monetary policies in this space as well. But apart from that, while China has boosted consumption when it comes to automobiles and electronics, but it really is the real estate sector that the street is keeping an eye on until you see a boost, a liquidity injection in that space, that specific sector rather. Not too many metals are going to run up. So that's exactly what's weighing onto the markets here. You have copper prices, which have seen 3% of a decline in the past week, and zinc continues to underperform. We've seen 4% of a cut in the previous week, and with that, the zinc prices now are trading at a 3-year lows as well.
All right, Manisha, thank you so much for joining us with that commodity action. And with that, it's a wrap in this edition of Markets Today. Thank you for watching.